Welcome everyone, and thank you for being here today. Today we're going to talk about savvy IRA planning for baby boomers. You know, a lot of people have a plan for accumulating money for retirement, but far too often that's where the planning stops. That is not good enough. The reality is that a sound distribution strategy, in other words, a plan for taking money out of your retirement accounts, is just as important, if not more so. When it comes to your IRAs and other retirement accounts, you probably have a lot of questions like, how much are my withdrawals taxed? When do I need to begin taking withdrawals? How much money do I have to take? What happens to my IRA when I die? And perhaps most importantly, how can I minimize my taxes so I can spend more of my hard-earned money? We'll discuss each of those questions today, but before we do, pause this video if you'd like to learn a little bit more about myself and my company. My name is Kim Anderson, and I'll be your facilitator for this afternoon. Now that you know a little bit more about me, let's talk about some savvy IRA planning strategies. You know, years ago, life was simpler in many ways, and retirement was really no different. Many people went to work, and then when they retired, they collected a pension and Social Security benefits. There wasn't as much needed in the way of planning, and people weren't all that concerned about running out of money, since both of their pensions and their Social Security benefits were generally guaranteed. For most people, that, along with whatever else they had managed to save along the way, was enough. Today, though, things are different. Companies and other organizations have abandoned pensions in mass numbers and instead have turned to 401ks and similar plans, shifting many of the risks they once shouldered onto the backs of their employees and their families. Retirees are now responsible for making more of the critical decisions that will determine how successful they are in retirement. In short, today, more than ever, when it comes to your retirement, you are on your own. On top of that, your retirement savings may have to last you a lot longer than you think. According to a 2011 Society of Actuaries report, over 40% of retirees underestimate their life expectancy by 5 years or more. Take a look at this chart to see what I mean. If you're a man and you're 65, you have a pretty good chance of living to at least 85. If you're a woman and you're 65, you have a better chance of living past 85 than you do dying before it. And if you're married and both you and your spouse are 65, then there's a 50-50 chance that at least one of you will live to be 90. In fact, there's a 1 in 5 chance that at least one of you will live to be 95. That means your retirement savings could easily have to last you 20, 25, 30 years, or even longer. That's probably much longer than a lot of you have considered. Put all this together, and it makes having a plan all that much more important. With that in mind, one of the best things you can do as you approach retirement, if you're not already there, is to beef up your retirement savings by contributing as much as possible to tax-favored retirement accounts. Although contributing at younger ages is more powerful because it gives your contributions more time to compound, you may have been unable to save as much as you wanted to because you were bogged down by mortgage payments, were saving for a child's education, or had other expenses associated with raising a family. Chances are you no longer have those expenses, or they will be ending soon. As a result, you may finally have discretionary income that can be used to fund your retirement accounts. So just how much can you contribute? Well, that depends on the type of retirement account, as well as a number of other factors. Let's begin with traditional IRAs. A traditional IRA, or individual retirement account, is a personal retirement account that offers certain tax benefits. Contributions may be tax deductible, and while your money is inside the IRA, it grows tax deferred. Ultimately, when you take your money out, the money you take out is generally added to your income. But we'll talk more about that later. In 2019, the maximum you can contribute to a traditional IRA is $6,000. If you're 50 or older by the end of the year, though, like most of you, then you're allowed to make an additional $1,000 catch-up contribution, making the maximum you can contribute to an IRA for 2019 $7,000. You can't always make a traditional IRA contribution, though. For instance, to make a traditional IRA contribution, you must have what the tax code refers to as compensation. For most people, compensation is earned income, but it also includes a number of other incomes such as taxable alimony. It does not, however, include things like interest, dividends, capital gains, Social Security benefits, or unemployment compensation. For most of the time, if neither you nor your spouse work, you won't be able to make a traditional IRA contribution. The only other reason you could be prevented from making a traditional IRA contribution is your age. Once you reach the year that you turn 70 and a half, you can no longer make a traditional IRA contribution. Many of you probably know that there is another type of IRA called a Roth IRA. Roth IRAs are similar to traditional IRAs in many ways, but there are also some key differences. One of those differences is that you don't get to take a tax deduction when you make a Roth IRA contribution. Once your money is in a Roth IRA, it grows tax deferred like it does in a traditional IRA. The big benefit of the Roth IRA, though, and another key difference between it and traditional IRA, is that the Roth IRA distributions can be tax-free in retirement. If you've had any Roth IRA for more than 5 years and you're over 59 and a half, then all withdrawals from any of your Roth IRAs will be tax and penalty free as part of what's known as a qualified distribution. Even if you need to take a withdrawal sooner, you could always take out your Roth IRA contributions tax and penalty free. Some of the same contribution rules that apply to traditional IRA contributions also apply to Roth IRA contributions. For instance, the same $6,000 contribution limit applies. Similarly, if you're 50 or older by the end of the year, the contribution limit is increased to $7,000 thanks to the $1,000 catch-up contribution. Roth IRA contributions are also subject to the same compensation rules as traditional IRA contributions. If you have sufficient compensation, then the only two things that could prevent you from making a Roth IRA contribution is having too much income. You can see the income limits up here on the screen. Note that if you're a single filer, as long as your income is under $122,000, you can make a full Roth IRA contribution. Similarly, if you're married and file a joint return, then as long as your income is under $193,000, you too can make a full Roth IRA contribution. While some baby boomer couples retire at the same time, oftentimes one spouse retires before the other. In such cases, you may be able to take advantage of spousal IRA and/or Roth IRA contributions. These are special contributions that allow a spouse with compensation to make a contribution to the traditional IRA or Roth IRA of a non-working spouse. In other words, a non-working spouse can use the working spouse's compensation as their own. The spouse for whom the contribution is being made, however, must meet all of the other contribution rules applicable to the type of IRA. You might be asking yourself, can a $7,000 contribution really make a difference when it comes to my retirement? The answer is absolutely yes. Here's a quick example. Suppose you're 55 years old now and you plan to retire in 10 years, at age 65. The kids have flown the coop and you finally have a chance to focus on saving for your retirement. So you make a full $7,000 Roth IRA contribution annually until you retire. If, say, you earn 6% a year, then by the time you retire in 10 years, you'll have close to $100,000. But remember, you may need to plan on living until 90, 95, or even longer. So let's say that you leave the account alone and it continues to earn 6% per year. By the time you reach 85, even if you never put another dollar in after the first 10 years, you'd have nearly $300,000. Plus, since you made your contributions to a Roth IRA, the entire amount would be tax-free. Still think just $7,000 a year can't make a difference? Just think, if you're married and you were able to make the $7,000 contribution to both your Roth and your spouse's Roth, you'd have twice as much, tax-free. If you're still working and you have access to one or more plans through your current employer, you might be able to do even better. While the limits on contributions can vary depending on the type of account your employer offers, you can generally contribute more to your company plan than you can to an IRA. For example, in 2019, you can contribute up to $19,000 of your salary into a 401k, 403b, or similar plan. If you're 50 or older by the end of the year, then you can contribute an additional $6,000 as a catch-up contribution. bringing your total potential plan contribution to $25,000. Depending on your plan's provisions, you may also be eligible to receive employer contributions such as a company match or profit sharing contribution. As you can imagine, putting this type of money away for even just a few years can have a marked impact on your retirement savings. Plus, provided you meet the requirements we just discussed, you can make a contribution to your IRA or Roth IRA on top of your company plan contribution. Of course, at some point, you're likely to retire, and when you do, you'll be faced with one of your first major retirement decisions: what to do with the money you've accumulated in your employer-sponsored retirement plan. In many cases, people choose to roll their funds over to a traditional IRA or Roth IRA because they tend to offer greater control over one's retirement funds. They are not the only options, though, and such rollovers are not always the best move. Believe it or not, you may have as many as 6 different options for your employer-sponsored retirement plan funds when you leave work. You can see them here on the screen. Each of these potential alternatives offers unique benefits and drawbacks, so it's usually a good idea to discuss your options with a knowledgeable professional so that you can make a savvy decision that's right for you and your family. All right, getting money into your retirement account is only the first half of the story. Coming up with an efficient way of taking those funds out and avoiding costly mistakes is the other half. This is far easier said than done, particularly when it comes to your traditional IRAs, 401ks, 403bs, and other pre-tax retirement accounts. In general, withdrawals from these accounts are taxed at ordinary income tax rates, just like interest. Your withdrawals are added to your income and taxed at whatever tax bracket you happen to find yourself in. If your overall income is relatively low, you might have a low tax rate for your withdrawal. On the other hand, if your overall income is higher, your tax rate will be higher and more of your IRA withdrawal will end up in Uncle Sam's hands. Here's a quick look at the tax brackets for a single and joint filer for 2019. One of the troubling aspects of IRA planning is that the tax rate on your future distributions is unknown. Even if you can project your income with relative confidence, there's no guarantee that the tax rates will remain the same. And while it's hard to find someone who doesn't think they pay too much in taxes now, the reality is that the top tax rates today are pretty low in historical context. Take a look at this chart to see what I mean. When the income tax was first introduced in 1913, the top rate was only 7%, but within just a few years, the top rate was had already skyrocketed to over 70%. After dropping back down to as low as 25% after World War I, the top rate jumped to 63% in 1932. From there, it wasn't until more than 50 years had passed when, in 1987, the top tax rate finally dropped back below 50%, letting those in the top tax bracket keep more of their income than they were forced to give over to Uncle Sam. Now, of course, not everyone pays the top tax rate. In fact, it's only a very small percentage of taxpayers that do. That said, with our national debt at an all-time high, a budget that hasn't been balanced in years, and fiscal troubles for many of our entitlement programs like Social Security and Medicare, it's possible that rates could go up across the board. That makes coming up with the right plan even more important. To make matters even worse, your IRA withdrawals can cost you in a lot more way than just adding to your income. They can also cause you to be phased out of itemized deductions, personal exemptions, and various tax credits. They can increase your exposure to the 3.8% surtax on investment income. If you take an IRA withdrawal, you might have to include more of your Social Security benefits in income, and your Medicare Part B premiums can increase. And that's just the beginning. If you want to try and avoid these issues, then you need a plan. One way to minimize the tax impact of retirement account withdrawals is to avoid taking withdrawals altogether. That allows your retirement money to grow tax deferred and keeps that nasty taxable income off of your tax return for as long as possible. You can't put off taking withdrawals forever, though. Once you turn 70 and a half, the law requires that you begin to take what is known as a required minimum distribution, or RMD for short, from your traditional IRA. The same rules generally apply to employer-sponsored retirement plans like 401ks. RMDs are simply the bare minimum you are required to take from your retirement account each year to satisfy the tax code's rules. You can always take more, but if you fail to take at least the minimum amount, the IRS can actually hit you with a 50%, that's 50% penalty for any amount that you should have taken but did not. To calculate your RMD, you need to know two things: your prior year-end balance and your life expectancy factor. Getting your prior year-end balance is usually pretty simple. In most cases, you can look at your December or fourth quarter statement and use the ending balance. Then you use your age to look up your life expectancy factor on a special table provided by the IRS and divide your prior year-end balance by that factor. For example, suppose you're calculating your 2019 RMD. The first thing you need to know is your prior year-end balance. So let's imagine that your December 31st, 2018 IRA balance was $200,000. That's part one. Next, you've got to figure out your life expectancy factor. Most IRA owners use what's called the Uniform Lifetime Table to calculate their RMDs. If you look on the screen, I've given you some of the life expectancy factors. So let's imagine that you turn 75 this year. Now we simply go to the table and look up the factor for a 75-year-old. As you can see, the factor for a 75-year-old is 22.9. So to determine your RMD in this hypothetical example, we divide $200,000 by 22.9 and get $8,733.63. Then each successive year, you do the same thing. Take your prior year-end balance and divide it by your new life expectancy factor. Not too bad, right? Of course, most people don't think about things in terms of factors or life expectancies. So here's a chart I think you'll find helpful. It shows the approximate percentage you need to take out of your IRA from age 70 to 89 in order to steer clear of the 50% penalty. If you look, you'll see that each year the percentage you need to take out increases. That doesn't necessarily mean you need to take out more money each year, though, as that also depends on how much your IRS gains or loses from year to year. RMDs can actually get much more complicated, and as we've already discussed, the penalties for making a mistake can be pretty severe. With that in mind, let me tell you about 3 of the most common RMD mistakes people make so you can avoid them. Remember, part of any savvy IRA plan is minimizing costly mistakes. One common RMD mistake people make is incorrectly aggregating their RMDs between different types of retirement accounts. For example, suppose you have a 401k and an IRA, and after calculating your RMDs for each account, they come out to be $4,000 and $3,000 respectively, for a total of $7,000. Now imagine your IRA is earning a higher rate of return than your 401k. You might be tempted to just pull out $7,000 from your 401k, leave your IRA alone, and call it a day. After all, what's the difference, right? They're both retirement accounts, and whether you take $7,000 from just your 401k or $4,000 from your 401k and $3,000 from your IRA, it's the same impact on your tax return. That's pretty logical thinking, but the tax rules are anything but logical, and they specifically prohibit you from doing that. An RMD for one type of account, like an IRA, can never be taken from another type of account, like a 401k. Another common RMD mistake is aggregating RMDs between spouses. For instance, suppose you and your spouse file a joint tax return. You have an RMD for your IRA of $4,000 and your spouse has an RMD for their IRA of $2,000. To make things easy, you simply take $6,000 out of your IRA. After all, they're both IRAs, and since you filed jointly, the income will show up on the same return, right? While that may be true, it doesn't matter. Retirement accounts are individual accounts. There's no such thing as a joint IRA or joint 401k. So you must always take your own RMDs from your own accounts. And a third common RMD mistake is forgetting to take an RMD altogether. Although this should never happen, sometimes mistakes are made. It's just a fact of life. Maybe a family member got sick and you got preoccupied. Maybe you were away on your dream vacation that simply slipped your mind. Whatever the reason, if you forget to take an RMD or you've otherwise made a mistake, the one thing you should not do is forget about it and pretend that it never happened. In most cases, if you do this, the the IRS can come back and assess the 50% penalty along with a host of other penalties and interest indefinitely. One strategy to minimize the impact of taxes on your retirement savings is to avoid taking distributions from your IRA for as long as possible. This allows your retirement money to enjoy its favorable tax-deferred status for as long as possible. It also helps to keep income off your return, which, as you've already learned, not only helps keep your income tax bill lower, but can also help prevent increases in other costs tied to your income. There are some major downsides to this approach, though. Most notably, as your IRA gets bigger, so does your problem. Think about it. If your tax bracket remains about the same over time, then as your IRA grows, so does the amount you're eventually going to have to pay Uncle Sam. This is much different from other things that you may be used to. For instance, imagine you buy a house for $200,000 and have a $50,000 mortgage. If the house doubles in value to $400,000, does your mortgage increase to $100,000? No, of course not. You get to reap all the benefits of that appreciation, but that's not the way it works with an IRA, 401k, or somewhere account. If those accounts double in value, you don't get to keep all the gains. Uncle Sam is entitled to his share. Plus, by waiting to take distributions for as long as possible, your required minimum distribution later will be larger. This could increase the impact of some of those side effects we just talked about. Thankfully, there's a way to fix this so that, to go back to the mortgage analogy for a moment, you can own your IRA free and clear so that only you benefit from future appreciation. And it's called the Roth IRA conversion, and it's our next savvy IRA planning strategy. A Roth IRA conversion is the name given to a special type of transaction where you move money from pre-tax retirement accounts like an IRA, 401k, or 403b to a Roth IRA. When you make a Roth IRA conversion, the amount of money you convert is added to your tax return for the year and is taxable at whatever income tax bracket you happen to be in. For example, let's say Jill has $100,000 in a traditional IRA and would like to convert it to a Roth IRA. We'll talk later about why she might want to do that. If Jill moves forward with her $100,000 Roth IRA conversion, she'll have to add $100,000 of income to her tax return for the year, which will be taxable at whatever rate Jill happens to be at. Because this is a big decision and can have a significant impact on your taxes, it's always best to discuss this option with your tax and financial advisors beforehand. So why would you voluntarily choose to make one of these Roth IRA conversions and pay taxes before you have to? Well, there are a lot of reasons, but perhaps the most common reason is the one we've already discussed. To pay off Uncle Sam now so you can own your retirement account free and clear for life. Remember, with a Roth IRA, you have the potential for future tax-free withdrawals of everything in your account. If you are over 59 and a half and have had any Roth IRA for more than 5 years, then all withdrawals from any of your Roth IRAs will be tax and penalty free for life. If you're over 59 and a half but haven't had a Roth IRA for 5 years yet, you can still take out any of your converted amount tax and penalty free at any time. If you're younger than 59 and a half, other rules apply. Something else to keep in mind is that unlike Roth IRA contributions, there are no restrictions on who can make a Roth IRA conversion. You can't be too old, you can't be too young. You can be working or you can be retired. There's no minimum amount of income you need or maximum amount of income you can have. I think you see what I mean. If you want to convert your IRA to a Roth IRA, there is nothing in the tax rules that will stop you from doing so. The potential tax-free nature of the Roth IRA may also provide you with additional benefits, such as a hedge against tax rates rising in the future. When it comes to your retirement, there are lots of unknowns. What will the market do? What will inflation be like? What will your tax rate be? And so on. The last one, taxes, is a major concern for many retirees and one we've already talked about a bit. A Roth IRA conversion can help manage that risk by paying taxes at today's known rates. If taxes rise in the future, tax-free distributions from the Roth IRA will be made even more valuable. Of course, if you think your tax rate will be lower in retirement, then you would want then that may be an indication that this strategy may not be right for you. Also, since Roth IRA distributions in retirement are generally tax-free, they typically don't impact the other things tied to your income that we discussed earlier. Another big benefit of the Roth IRA, and one that many retirees find attractive, is that the Roth IRAs have no required minimum distributions during your lifetime. Remember all those RMD calculations and potential mistakes we talked about earlier? They're not an issue if you have a Roth IRA. During your lifetime, you can take as much or as little as you want. You're not forced to take anything at 70 and a half if you don't want to. That means your Roth IRA can continue to grow and compound tax-free for your heirs, which also makes it a very intriguing vehicle from an estate planning perspective. The Tax Cut and Jobs Act, however, eliminates this option for conversions made in 2018 and later. If you convert your Roth IRA now or in the future, you are stuck with that decision. Even if your tax bill is higher than you thought, or if the conversion accidentally phased you out of a credit, or if your investments dropped in value, no matter what the reason, you cannot recharacterize that conversion. So with that in mind, it's very important that you are sure you want to convert your Roth IRA before doing so. There are 3 questions to ask yourself before converting. Do you have a rough idea of the conversion's impact on your tax bill? Do you have a plan to pay the resulting taxes? Do you have a reasonable expectation that the benefits of prepaying your taxes like this make sense in your overall plan? The answer to all of these questions should be yes. So here's a savvy conversion strategy that might be helpful for you, called filling up the bracket strategy. Remember those tax brackets we talked about earlier? Well, sometimes you can find yourself in the middle of one of them with room to add more income without pushing yourself into one of the higher tax brackets. For example, in 2019, the 20% tax bracket for married couples filing a joint return goes from about $79,000 to about $168,000. Suppose then that you file a joint return and your taxable income is $100,000. That means that you could add another $68,000 of income without going into the next tax bracket, making a Roth IRA conversion of that remaining amount can make sense for you. If you plan to convert a sizable portion of your IRA, this approach is often more tax efficient than converting the full amount at one time. Instead, you can make smaller Roth IRA conversions over a number of years, filling up your bracket each time. This can help reduce the average tax rate you'll pay on your converted money and also spreads the tax bill out over a longer period of time. Roth IRA conversions can be especially useful if you had a low income year. For example, are you a business owner with an unusually low sales, or are you paying high non-recurring medical bills? Or maybe you're retired but not yet receiving Social Security benefits, pensions, or IRA distributions. These are questions to ask to see if a Roth conversion is a good move for you. Of course, these strategies aren't for everyone, as you can see here, and there's no guarantee that a Roth conversion will achieve the intended results. There's a good chance that at some point during your life, you're going to want to move around some of your retirement money. Maybe it will be done as part of the Roth conversion. Maybe it will be done to make a new investment, maybe to work with a new advisor. Whatever the reason, you should be aware of how to move retirement money so that you don't make costly mistakes that could derail your retirement. In general, there are 2 ways you can move retirement money. You can either move it indirectly in what's known as a 60-day rollover, or you can move it directly via a direct rollover or trustee-to-trustee transfer. Moving money directly is usually the savvy choice. First, let's take a look at indirect rollovers. In an indirect rollover, you receive a distribution of your retirement funds payable to you, or they are sent to a non-retirement account. Then you have 60 days from the time you receive your distribution to get it back into another retirement account. If you miss the 60-day deadline, the distribution is taxable, and depending on your age, it may also be subject to an additional 10% penalty. Even if you're on top of things and you complete your rollover within 60 days, there are other problems with indirect rollovers. For instance, if your withdrawal is coming from an employer-sponsored retirement plan like a 401k, the plan generally has to withhold 20% of your distribution for income taxes. Congress wants to make sure you don't take your retirement money, run away, and never pay the taxes you owe. A separate troublesome rule applies to 60-day rollovers from IRAs. If you're moving your money to another IRA, only one of these rollovers can be done per year. If you try and make a second 60-day rollover, chances are the entire amount will be taxable. The same rule applies to Roth IRA rollovers. As you can see, there are some real problems with indirect rollovers. Thankfully, there's generally a better way to move your retirement money. In a direct rollover or trustee-to-trustee rollover, your money is sent right from your old retirement account to your new retirement account. There's no 60-day timeline to worry about, and there's no mandatory 20% withholding, and there are no one rollover per year rules to be concerned about. Typically, this is done by providing you with a check made payable to your new custodian. For example, the check might read Company X Custodian for the benefit of John Smith IRA. If the check is made payable to your new custodian like this, your distribution can still qualify as a direct rollover and get the same favorable tax treatment. There is no 60-day deadline and no mandatory withholding. That's true even if your plan sends you the check and has you forward it to your new custodian. Another essential component of Savvy IRA plan is to make sure that you coordinate your IRA planning with your overall retirement, estate, tax, education, and financial plans. Your IRA and other retirement accounts can impact each of these areas, and it's important to factor those things into your planning. Some of you may have all of your savings in retirement account, but many of you probably have some of your savings in IRAs, 401ks, and the like, with other savings in non-retirement accounts. If that's the case for you, one savvy strategy you may want to consider is coordinating your IRA with your overall plan and carefully selecting which of your investments are purchased with IRA money and which investments are purchased with non-retirement account money. Doing so could help you meaningfully lower your tax bill. Here's an example of what I mean. Let's imagine that you have $100,000 in an IRA and $100,000 in a non-IRA account. Let's also imagine that you want to purchase $100,000 of bonds with a hypothetical interest rate of 4% and $100,000 of stock that will pay hypothetically qualified dividends of 4%. Also assume that you plan to live off the income these investments generate and that you're in the 24% tax bracket. In the first scenario you see, all of the stocks are purchased inside the IRA account and generate $4,000 of qualified dividends. In general, qualified dividends receive special tax treatment and are taxed at long-term capital gain rates. These rates are lower than ordinary income tax rates. However, because these investments were made inside an IRA and all withdrawals from an IRA are taxed at ordinary income tax rates, if you take a withdrawal of the $4,000 of qualified dividends, they're still taxed at your hypothetical 24% ordinary income tax rate, resulting in a tax bill of $960. In the same scenario, you have $100,000 of bonds that also generate $4,000. Bond interest is taxed as ordinary income too, so that means that you'll owe another $960 of tax on that income, bringing your total tax bill to $1,920. In the second scenario, the bond purchases are made inside an IRA. They generate the same $4,000 of interest as before, and if withdrawn from the IRA, will be taxed at your hypothetical 24% rate. This gives you the same $960 tax bill for your interest as you had before. Now, however, you're purchasing your stocks with non-IRA money, and your qualified dividends are taxed at long-term capital gains rates. If your ordinary income tax bracket is 24%, then you have a 15% rate on long-term capital gains. Now your tax bill on your qualified dividends drops to $600, bringing your total tax bill to $1,560. That's a $360 difference compared to the first scenario and a tax savings rate of nearly 25%. In both scenarios, you invested exactly the same amount of money in exactly the same investments, and you took exactly the same investment risk. However, In scenario 2, you get to spend an extra $360 simply because of your savvy planning. So remember, when it comes to your investments, it's not just what you own, but where you own it. Of course, you should be made aware that anytime you're dealing with investments, there's no guarantee they're going to perform as expected. And while I don't anticipate the special tax rate for long-term capital gains to be eliminated anytime soon, there's no crystal ball to predict what Congress will do in the future. Another way your IRA planning needs to be coordinated with your overall retirement strategy is your Social Security claiming strategy. The decision of when to file for Social Security is one that far too many retirees make without thoroughly evaluating their options first. This is a major mistake, and one that in some cases can cost you more than $100,000 of income over the course of your retirement. Now, the decision of when to claim Social Security is a very personal decision, and one that varies significantly from person to person and couple to couple. That said, many retirement experts today believe that too many people claim Social Security too soon. Remember, Social Security benefits are guaranteed to last your entire lifetime, no matter how long you live, and benefits are generally increased from one year to the next through a cost of living allowance or adjustment. Additionally, delaying Social Security benefits past what's called your full retirement age, 66 for most of you, can allow you to earn an additional 8% increase in payments each year until you turn age 70 through what is known as deferred credits. For these reasons and more, it may be beneficial to claim Social Security benefits later than you initially planned for. But you have to eat in the meantime, right? That might require you to pull some money from your IRA in the interim to help cover your current living expenses. Retirees sometimes opt not to do this because they say, what if I die early? I'll have spent my IRA money, which takes away from my heirs, and I'll have gotten little to nothing for it. While that's certainly something to consider, here are 2 reasons you may want to give that approach a second thought. First, a 2012 report from the Center of Retirement Research at Boston College concluded that Social Security is one of the cheapest, if not the cheapest, annuity available. That might sound a little funny. After all, you don't buy Social Security, right? In a way, though, you kind of do. If you use IRA money to hold off on claiming Social Security for, say, a year, that's kind of the price you paid to get the higher benefit. If you compare that price and increased benefit to what you can get from commercial annuity providers, it's almost always cheaper. Another reason it can make sense to draw from your IRA in order to help delay claiming Social Security benefits is that Social Security benefits are generally more tax efficient than IRA withdrawals. Remember, when you take an IRA withdrawal, the entire amount is generally added to your income and taxed at whatever rate that you happen to be at. In contrast, Social Security benefits may be anywhere from 15% tax-free all the way up to 100% tax-free. So the key point for you here is that trading $1 of IRA income on your tax return for $1 of Social Security benefits will almost always leave you with a lower tax bill and more money to spend. All right, time to move on to our next savvy IRA planning strategy, and that's coordinating your IRA planning with your estate plan. In most estate plans, there are really 2 primary goals. First, to make sure that your assets pass your intended beneficiaries, and second, that they are passed to them as efficiently as possible. When it comes to IRAs, 401ks, and other retirement accounts, that's done with one form in particular, the beneficiary form. I can't really emphasize how important this form is, and yet, time and time again, people fail to update these forms after major life events, such as births, deaths, marriages, and divorces. Many times, people think that because they've updated their will, everything is taken care of, but that's not so. For example, if you have your ex-wife or ex-husband named on your IRA beneficiary form, but your will has been updated to say that all your assets go to your children upon your death, guess who's getting your IRA? That's right, your ex. And I can't tell you how often this happens to people. That's why it's so important to keep an updated copy of your beneficiary form with all your other important estate planning documents. Now that you understand the importance of the beneficiary form, let's talk a little more about IRA beneficiaries. Any person or entity can be an IRA beneficiary. but there are different post-death withdrawal rules depending on the type of beneficiary you select. Broadly speaking, there are two main types of IRA beneficiaries: designated and non-designated. A designated beneficiary is generally a living, breathing person, such as your spouse or child, although certain trusts can also qualify. A non-designated beneficiary is any other beneficiary, such as a charity, your estate, or other entity. In general, designated beneficiaries enjoy greater tax benefit than non-designated beneficiaries. That's because only a designated beneficiary is entitled to utilize a special stretch IRA provision. You may have heard about the stretch IRA before, but didn't know what it was. So here's what you need to know. After you die, required minimum distributions must generally be paid to your beneficiaries beginning by the end of the year after your death. Designated beneficiaries, and only designated beneficiaries, are able to take minimum distributions calculated over their IRS-provided life expectancy. The stretch IRA, then, is just the name that practitioners have given the strategy of a beneficiary taking only the minimum distribution out of an inherited IRA each year that's required by law. Doing so helps a beneficiary to minimize their income tax and maximize the tax deferral of the inherited account. In contrast, a non-designated beneficiary typically has to withdraw all inherited IRA money much sooner. Here's an example so you can see exactly what I mean. Suppose you have named your daughter as your IRA beneficiary directly on your IRA beneficiary form. When she inherits your IRA account, she's 40 years old and the account is worth $100,000. This slide shows how much money your daughter could expect to receive from the inherited IRA if she stretched the distributions. Note that we're assuming a hypothetical 6% rate of return here, and that the actual rate of return your beneficiary received may be quite different. Although spread out over many years, in this example, your daughter would receive $450,000 from the inherited IRA. Now suppose that instead of naming your daughter directly on your IRA beneficiary form, you name your estate as your IRA beneficiary and your will names your 40-year-old daughter as the beneficiary of your estate. Would she get the inherited IRA? Sure, but since she inherited the IRA through your estate and not directly via the beneficiary form, she's not considered a designated beneficiary and cannot stretch the distributions over her life expectancy. Instead, she'd have to withdraw all the funds much faster. If, say, you died at 69, she'd have to completely empty the inherited IRA within just 5 years. Even if she waited until the last year to take out everything, if we assume the same 6% hypothetical rate of return, she'd still only receive $133,823 from the inherited IRA account. That's a big difference from the last example. And now you can see why the savvy approach is to skip the estate and name your beneficiary right on your beneficiary form. There is one big problem with the inherited IRAs that we should definitely discuss. They are extremely fragile. One wrong move by your heirs can render the entire account taxable, and a good portion of a lifetime's worth of savings can be lost to Uncle Sam in an instant. For example, inherited IRAs must be correctly titled. If you have multiple beneficiaries of the same IRA, separate inherited IRA accounts should be generally established for each IRA beneficiary by the end of the year following the year of death. And perhaps most importantly, inherited IRAs can only be moved via trustee-to-trustee transfer. If a beneficiary tries to move money through a 60-day rollover like we discussed earlier, the entire amount is taxable and there is absolutely no way to fix it. That's why we always suggest our clients talk about their IRAs with their beneficiaries and tell them that once they inherit, they should not touch anything until they speak with a qualified professional. One question many boomers ask is whether or not they should leave their IRAs to a trust. Trusts are certainly good at providing post-death control, and that's a major concern for you. It's certainly something to consider. However, naming a trust as your IRA beneficiary adds considerable complexity to your estate plan. If drafted properly, Trusts can be treated as designated beneficiaries and preserve the stretch IRA. All too often, however, they do not meet the specific requirements outlined by the IRS and end up having to follow the less favorable rules for non-designated beneficiaries. Even if drafted properly, trusts come with certain costs, such as the cost to prepare the trust itself, the cost for filing annual trust income tax returns, and accelerated taxation of any IRA withdrawals that are held inside the trust. Ultimately, naming a trust as your IRA beneficiary is a very complicated matter and is something that should be carefully considered and discussed with your full team of advisors, including your tax advisor, your estate planning attorney, and your financial advisor. Many people name their spouse as the beneficiary of their IRA, so let's talk about that for a moment. If your spouse is your sole IRA beneficiary, then he or she will generally have several options after inheriting your IRA. They include choosing to remain a beneficiary of your account, as well as making what is known as a spousal rollover. Let's talk about each of these in a little more detail. As I just mentioned, one option a spouse beneficiary has is completing a spousal rollover. In a spousal rollover, the surviving spouse takes the deceased spouse IRA and moves it right into their own IRA. A spousal IRA rollover is an irrevocable decision, and once completed, the funds are treated as though they were always in the surviving spouse's IRA. This is generally the best option for spouses who inherit at 59.5 or older. Another option available to spouse beneficiaries is remaining as a beneficiary of the inherited account. This is generally the preferred option if the spouse inherits prior to turning 59.5, because it allows them to take penalty-free distributions from the inherited account regardless of their age. In contrast, if they want to make a spousal rollover, the money would be treated as their own, and therefore any distributions taken prior to the age of 59.5 would generally be assessed a 10% early distribution penalty. If you're a spouse beneficiary and you inherit prior to reaching age 59.5, you can remain a beneficiary until you turn 59.5, and then at that time, execute a spousal rollover. In fact, more often than not, that's the best approach. There are other special rules that apply to spouse IRA beneficiaries, so it's always best to consult with a knowledgeable professional. With that, we've come to our last IRA planning strategy. It's one that you should know about, but for whatever reason, people seem to forget. And that's to always do your homework before making any decision with your IRA, especially when it comes to investments. IRAs are often the target of schemes and scams because, hey, let's face it, that's where a lot of people's savings are, right? I know it and you know it, but you know who else knows it? That's right, the scammers. In recent years, the SEC has issued alerts warning certain IRA owners that they may be target of scams. And the IRS has even put out a publication with the title, "The IRS Does Not Approve IRA Investments," in response to many fraudulent promoters claiming that their IRA investments were somehow given the green light by the IRS. At the end of the day, it comes down to the golden rule. If it sounds too good to be true, it probably is. Your IRA may represent a lifetime's worth of work and savings, so don't squander it by making a foolish decision. Well, we've certainly covered a lot of ground today, and you should have plenty of food for thought. As you probably realize by this point, IRA planning is a lot more complicated than most people realize. Let's face it, deciding what strategies are best for your IRA crosses into just about every area of planning, from tax planning to investment planning to estate planning. Few retirees are aware of just how critical IRA planning is, and even fewer have taken the time to truly evaluate all of the issues and develop a comprehensive solution. Hopefully, we've helped answer some of your questions for you today, but chances are you still have others. But that's okay. We are here to help answer your important questions, evaluate your current financial picture, and develop a savvy IRA planning strategy that's best for you and your family. Thank you again for joining me, and best of luck for continued success.